All right, let's get right into it. Today, we're digging into what makes a business really tick. We're talking about return on assets, or ROA. It's a powerful metric that shows us the true story behind a company's efficiency. So, let's dive in.
So, think about this for a second. We see companies reporting huge profits all the time, but how can you tell if the management team is actually any good? Is it just about the final profit number? Or is it about how smartly they use what they have to get that profit? That's the real question, isn't it? And it's what separates the good from the great.
Well, the answer comes down to this one ratio, return on assets. You can basically think of it as the ultimate efficiency score for a business. It takes a hard look at everything a company owns, its factories, its inventory, its cash in the bank, and it asks one simple, brutal question. For every single dollar you have tied up in all this stuff, how much profit are you actually generating? It doesn't care if you bought that factory with a loan or with investor cash, it just wants to know if you're putting it to work.
So when you see a number like this, what does it actually mean? Well, if a company has an ROA of 15%, it's telling you that for every single dollar's worth of assets on its books, it's squeezing out 15 cents in pure profit. It's a really clean, simple way to see how well that company is making its assets sweat. But here's the thing. That one number, it's just the tip of the iceberg. To really get what's going on, you have to pop the hood and look at the engine. You see, ROA is powered by two completely different forces, and this is where the real analysis begins. This right here is the famous DuPont decomposition, and it shows you the secret recipe. ROA is just a company's profit margin multiplied by its asset turnover. Now, this isn't just some boring math equation. It's basically the company's entire business strategy in two parts. It tells you a company can get a great ROA in two fundamentally different ways.
So you've got two main levers you can pull. The first is the profitability lever. That's your profit margin. How much cash do you actually keep from every dollar you sell? That's all about having a great brand, pricing power, and keeping your costs way down. The second lever is speed, your asset turnover. How fast can you use your stuff to make a sale? This is all about being incredibly efficient with your operations.
And this is where it gets really interesting, because every single business has to make a choice. A luxury brand like Ferrari makes an insane amount of profit on each car, but they don't sell that many. So, high margin, low turnover. Then you have a discount grocery store. They make pennies on each can of beans, but they sell millions of them. Low margin, super high turnover. Both can lead to a fantastic ROA, but they get there on completely opposite paths. You can't be both.
Okay, so you might be thinking, easy, a 20% ROA is way better than a 4% ROA, period. Well, not so fast. When we're talking about ROA, a number by itself is pretty much useless without context. I mean, just look at this. Industries that need mountains of expensive stuff, think of a utility company with power plants or an airline with a fleet of jets, are naturally going to have a low ROA. For them, 5% might be amazing. But for a software company that just needs laptops and smart people, that same 5% would be a total disaster. They should be way up over 20%. The only comparison that matters is how a company stacks up against its direct competitors.
All right, so let's say we've done our homework. We found a company with a high ROA for its industry. We're golden, right? It's a great business. Well, hold on. There's one more crucial test it absolutely has to pass. And this is the real acid test. A company only creates real value if its ROA is higher than what it costs to get the money to buy those assets in the first place. That's its cost of capital. I mean, think about it. If your company has a 15% ROA, but it's paying 18% in interest on its loans and returns to shareholders, it's actually destroying value. It's like running on a treadmill that's going backwards.
Now, even if you have all the right context, ROA can be a little tricky. The way accounting works can sometimes warp the numbers and hide what's really going on. You have to know how to read between the lines.
Here are 3 of the biggest traps to watch out for. First, assets are listed on the books for what the company paid for them, maybe decades ago, not what they're worth today. That can make the asset base look tiny and artificially pump up the ROA. Second, companies can use different depreciation methods that can swing the numbers around. And third, you have to watch out for one-time events, like selling off a building, which creates a fake spike in profit that has nothing to do with the core business.
But there's one trap that's particularly sneaky, because at first glance it actually looks like a good thing. Sometimes a rising ROA is actually a massive warning sign.
And here's the paradox. As a company's factories and machines get really old, their value on the balance sheet gets worn down to almost nothing. That shrinking denominator in the ROA formula, just by pure math, makes the ROA number go higher and higher. It looks fantastic on a spreadsheet. But what's really happening, the company is running on fumes, and a giant, multi-billion-dollar bill to replace all that ancient equipment is coming due, probably very soon.
So ROA is powerful, for sure, but it shouldn't be used in a vacuum. Its real genius, its true analytical power, is unlocked when you put it side by side with its cousins, like return on equity and return on invested capital.
So picture this. We're looking at a company, and we see its return on assets is a respectable 7%. Okay, not bad. It tells us their core business is pretty efficient. Solid, but not spectacular. But then, we pull up its return on equity. That's the return just for the shareholders, and it's a whopping 16%. That's more than double the ROA. So where on earth did all that extra return come from? Well, it's not magic. That huge gap between ROA and ROE has a name: leverage. It means the company is using a lot of debt to buy its assets. Now that juices the returns for shareholders when times are good, but it also massively increases the risk if things go south. That gap is the price of that risk. And this brings us to one of the biggest red flags in all of finance. If you ever see a company's ROA starting to decline, meaning its core business is getting less efficient, but its ROE is staying high or even going up, that is a huge warning sign. It often means management knows the business is weakening, so they're piling on debt to hide the problem and keep the shareholder return number looking good. And finally, for the ultimate, purest efficiency test, analysts often look at return on invested capital, or ROIC. As you can see, ROIC is a much cleaner metric. It strips out the effects of taxes and debt and only looks at the profit from the core business, divided by only the capital needed to run that core business. It makes it the best tool for an true apples-to-apples comparison of operational efficiency.
Which really brings this all together perfectly. This quote says it all. Return on assets isn't the final answer. It's not the last page of the book. It's the starting point. It's the clue that lets you start asking the right questions to unravel the real story of a business.
So, the next time you see a headline screaming about a company's record profits, I hope you'll think a little differently. I hope you'll ask that deeper, smarter question. Not just how much money did they make, but how efficiently did they do it? Because that's where you'll find the truth.